We will not go down the path of fiscal discipline. We will not. That ship has sailed.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back. Thank you for joining us for another edition of the Daily Dots. And I am joined as always by the brain trust himself, Mr. Chase Taylor. So a lot of different angles to discuss, a lot of different ways to approach today. Let's start off with the market rundown. What do we see?
S&P closed up 1.5, NASDAQ 2.2, equal weight up 1, small caps up 1, equal weight was up about 0.6. Mag 7 did the heavy lifting at up 2.7. All world ex-US up 1.26. Dollar flat. Oil up a little bit. Gas up a little bit. Gold up about 2.7. You had silver up almost 5%. Miners up almost 5%. Even copper up like 3%. So commodities staged a pretty significant rally. You had the 2-year yield up 3 basis points, 10-year yield up 2 basis points. Obviously, vol did not love today. It was down 6%, but you're still 18.6, so you're not really low on vol yet. And just one little thing that stood out to me today, like obviously Nvidia, stuff like that had a big day. So it's not like the whole AI trade still bad. Obviously, with Mag 7 having a huge day, but Oracle was only up 0.6, underperformed. You had Meta up 1.6. That's underperforming.
I also think
NASDAQ,
I also think I also think it's interesting where a lot of those AI and Mag 7 names kind of topped out on the day. You know what I mean? They didn't. Yeah, I don't think today. I know you and I came in today expecting a rally.
Yeah, I mean the shutdown looks like it's ending, so like that's worth 2% on the NASDAQ. That's fine, whatever.
Yeah, I mean it's narrative wise, it's worth 2%.
Right.
I always laugh because naturally the market's up because shutdown's ending, and you're like, oh yeah, so we're recovering from when it dropped because of the shutdown, right? Oh wait, it didn't.
1/2 of that 3% drawdown might have been, but you're right.
Yeah, but look, that doesn't mean anything either. That's totally anecdotal. It market could be right. I do not read a day like today like everything looks good. I still think this market is, I'm actually going to change my tune, and I'm going to do that with the full knowledge that means that the antithesis is probably
you're marking it.
Yep. I do think that we're going to. I do think that short-term tops are in. And I think that we will. My guess is we will be 5 to 7% below where we currently are before the end of the year.
If you remember, if we go back to the very beginning of the year, my foolish outlook is you should, if anytime you put an S&P target for a year, you're just putting your finger in the wind.
You're throwing a dart at a board, yeah.
But my guess was high single digits. So if you're right, that would make me right on being around high single digits. I don't know if I'm that bearish. I want to be, but I don't know if I am. But I will say, like, I'll call a top on Oracle. I don't think Oracle puts in a new all-time high in the next year. Call it and it maybe even Meta. Like I still think all this off-balance sheet debt and just significant debt in general. I think the market finally woke up to it, and now I think more people will pay attention to it in the next earnings call. So if they come out and be like, just kidding, we're going to do more capex than we told you, and we're going to do it with debt, some of it with debt, I think the market's going to be like, no, you're not. Like, I do think there's going to be some discipline there. I will say over the weekend though, it wasn't just the shutdown because we had the 50-year mortgage talk and we had the $2,000 stimulus check talk. So that is like nitroglycerin bull market material. No, obviously, and that's not like that stuff's working through Congress. It's just talk over the weekend. But like, that is, if that doesn't get the market up, I don't know what would.
You know what we're dealing with? Well, in the fact you had a sell-off, right? That's why you and I were looking for a bounce into Monday anyway. You go,
I
look what is,
thought it'd be AI narrative, not like government narrative over the weekend. But
also Mondays are great for markets. We've had 9 straight green update Mondays, right? And the vast majority of Mondays this year have been green as well for whatever reason. No, but like you said, in the environment that we are currently in, I don't think you can look at the end of the shutdown, a $2,000 stimmy check, and a 50-year mortgage. That's the gasoline that lighted this fire in the first place, and it makes it totally understandable why the market would rally.
right.
I cannot help but thinking. I put out a tweet today. Speaking of the $2,000 stimmy check and a 50-year mortgage, I can't help but sitting there thinking, I'm like, this is where ZERP and QE get you, right? This is where, because
You're trying to chase that high.
Yeah. And this is the frustrating part. And this is why we've said all along. And if you're still not getting the narrative, it's because you don't want to. It's right there for you. Okay. We will not go down the path of fiscal discipline. We will not. That ship has sailed. We will extend and pretend if it takes 100-year mortgages, they will get them.
Right. Nothing. Yeah, Ben Hunt said, just go interest only perpetual and get it over with.
Yeah, just do it. Yeah, there you go. And you know what? Honestly, I wouldn't be surprised if that comes to the fore at some point.
There are some Northern European countries that have extended duration to shocking levels.
Now, think about what that means, though. Here's the other distortion. Think about what that means. What that means is you have a completely artificial real estate market.
Yeah, 100%. And it means equity becomes very scarce in the future.
Yeah. And it will, here's the other irony. Everything they're doing will drive prices higher.
Oh yeah, you basically undo the benefits by jacking the price up very quickly. So the anyone that doesn't jump in on the first, couple months of that change would be basically in the same like left behind camp. So if you're Gen Z and or Gen Alpha coming up, like your attainability to owning a home on any sort of real level is even further away, because the $800,000 house you thought you were going to have to save 5 years for becomes a $2 million house you have to save 25 years for.
But in the interim, if this 50-year mortgage hits when it hits, it
will create a boom.
It's going to create another boom.
100%. I mean,
people
will.
No, because
no one will be smart with it. They'll spend all the excess money and.
Here is the problem when you do crap like this, when you go down the ZERP and QE road, because what are you doing? You're incentivizing them to make poor financial decisions, right? Because, and really incentivizing them. If I'm a 35-year-old trying to buy my first house, the minute I am filling out a 50-year mortgage application, the minute I can, and buying something immediately, because you have to. You have to
be the front of the trough.
Yes, because everybody else going to get it and drive it up on you.
Right.
And then
I will take out every dollar that a lender will give me and put it in real estate, because I know what will happen to the price.
Well, guess where the median house price is going to go immediately once they launch the 50-year mortgage? It's going to go up to where the 50-year mortgage payments reflect the exact same payments that nobody could pay on the 30-year.
Nailed it. The perfect summary right there.
That's what's going to happen.
Yeah.
So that's
a great way to boil it down.
The financial engineering has to stop at some point. The problem is, like we've said for years and years and years, every time you do this, you bake into the cake the fact that you're going to have to do it again, right?
Yeah.
Like
right. 20 years from now, or 10 years from now, or 5 years from now, we're like, well, that one trick pony stopped doing its trick. So how do you feel about 100 years?
Yeah. And then what does that do to inflation?
Then you're just renting your house, right? I mean,
what would be an interesting one to look at, and it's going to be one to watch. Would they roll out that 50-year mortgage? I want to see what happens to inflation expectations immediately.
Right. And I want to see what happens to the 30-year bond. Like that is an insane amount of duration supply. I mean, insane amount, especially with refis, because everyone's will refi into it too. Like I was telling Jason over the weekend, I'm like, I'm going to call my mortgage broker and say, like, I want every dollar you can give me if this happens on day one. Because
no one's going to have any equity.
I'm going to buy a house day one. And also, can I get equity in your mortgage brokerage firm, please? Because your transaction volume is going to be insane for the first year.
Yeah.
I would like to cash out after a year, please, but
I wonder what that will do to paint. I'm curious to do what I know the way mortgages work, but I can't sit there off the top of my head and go immediately what it converts to. I wonder what the difference in payment will be, all things held equal, between a comparable 30-year and 50-year, because like a 15-year is like, if I'm not mistaken, I want to say like a 15-year costs you like 50 or 60% more on a monthly payment, something like that, right in there.
Yeah.
So I'm wondering, the flip side to think about it is a 30-year saves you 40%, 35, 40% in a payment. I wonder what the 50-year would be. I wonder if it's similar. It probably, I would think it'd be a similar discount from the 15 to the 30.
Yeah. 20, you're adding 20 years instead of 15 though. So maybe stretches that curve a little bit more. And the rate,
it's going to be a little higher
in Europe where you see some of this, the rates, it's about 50 basis points spread between a 50 and a 30. So that would be roughly 50 basis points higher for the rate.
It could be really good for existing homeowners too.
Yeah. The golden handcuffs thing we've talked about, where people are stuck. A lot of people will be like, oh, this is my way out.
Yeah. Yeah.
Well, it will unfreeze the real estate market in a very significant way. A lot of people will extract equity.
How soon do we think this thing will hit?
That I have not heard. And I know
I would think quick. I mean, it's not going to be hard for them to put a 50-year mortgage out.
I wanted to look deeper into like how that works, but I haven't seen, how it works regulatorily and
what have happened to home pricing stocks since
the only way I think this would work is if you had all the government implicit guarantees behind it for any Fannie, Freddie, VA, and all that kind of stuff, because
they have to. Nobody can underwrite it.
Right. Like no bank would, like no one would be like, yeah, I'll finance 50 burger. Especially you think about the inflation hedge aspect of it. It's hard to design a better inflation hedge than a 50-year mortgage. So no one would want that risk. And if they did, they would want to offset it with betting against duration, So you'd have to have the government come in and be like, no, we'll take care of it,
What have we seen any significant reaction to housing stocks since the talk of the 50-year mortgage started coming? If that 50-year mortgage hits, you're going to see a housing boom. I can't see any way around it.
Maybe. I mean, it's a tough one because you already have a pretty big overhang in supply.
Yeah, but you remember so you got to think about it in terms of the monthly payments. The minute they launch that 50-year mortgage, assuming it doesn't have some kind of
demand stimulant of epic proportions.
It's a price reduction in the space of 25%.
Right. And I think the key becomes, is it just anyone can do it? It's just go get it? Or is it like higher? I'm assuming no on all of this, but
it's got to be geared to the lower end of the income scale.
You would only have, if you're going to do it in a way that's not insane, well, I wouldn't do any of it. But if you made me do it limited basis, yeah. If above certain income, sorry, you ain't doing this. And,
this is
maybe you have to be first time, you have to be under a certain age. Like you can't have another home, like putting a bunch of boundaries around it.
This is, I've taken some flack when I've said this and I've been accused of being insensitive or whatever, and I'm not, but this is precisely what I meant when we were talking about recessions, and that there's a cost to everything, right? So all too often we look at stimulus or bailouts that prevent a recession or an economic downturn as a good thing because it prevents the pain, right? But when you do it long enough, you get to a place where, and I think we're looking at it right now, look at all the issues we're dealing with. And so many of these issues could have been addressed by a recession. Right now, I know a recession is very uncomfortable for a lot of people. I know that people lose lives, right? I know, like I understand.
There's a very human cost to it.
Yes, and I totally get that. But I'm looking at the cost, and I see the cost all around us of the profligacy that we've experienced, and I look around and I'm like, in all the things that we're doing now, just magnify those issues out of the future. And it's really hard for me to look at the setup right now and go, hey guys, wouldn't a recession at some point over the last 8 years been better than this?
Yeah. I think at the end of the day, we had those elections come through. It became super clear that cost of living is like a massive driver of it. So the fact that this happened right after that tells me that is the political consequences became a policy objective. What kills me, and this is not new, is every time someone wants to address the cost of living, it's like, well, how can we stimulate demand? And I'm like, well, no. Like, stop taking the demand side of this stuff.
No
like,
kidding.
That's not going to lower the cost of living. It's going to do the opposite.
Address the structural issues.
Yeah, and if you are going to do this, then like all those boundaries I just talked about, like you better make it tight. Like it can't be like, oh, who wants a 50 year? Let's come do it, because then it'll just be a giant bubble. So now if they rolled it out,
they're not going to do that. They're going to
because they want that boom. They want that run.
It's going to be like Oprah. Who wants a mortgage?
Yeah.
You get a mortgage. You get a mortgage. You get a mortgage.
Yeah.
And the other side of it is, what's the point in launching the 50 year if that's not what you're doing?
Right.
You know,
and in politically speaking, it's brilliant, because you'll be able to talk about how great the economy's doing, how much people's mortgage payments went down, and like you could look at, we help the young people and the blue collar people. They can afford a house now. I mean, they can afford way less house now in reality, but like the political talking points on it will be, I mean, wonderful. Like they often are whenever you give people
the problem is
a big sugar high.
Yeah, no, I mean, and here's the problem. You know who the big winners are from the 50 year mortgage? The guys that own the most houses.
Yeah, and it honestly, rich people is the answer. I mean,
Yeah.
So
yeah,
it does very little to medium term address all the inequality problems that are political problems and are structural society problems.
Like you said too, man. Equity, home equity. You roll out a 50 year mortgage, home equity is going to become like an endangered species.
Oh, I mean,
yeah. Forget about it.
You know, so I have a 20-year boat loan. 20, not 50.
Yeah.
And it's crazy to watch how much principal comes off that thing. It's like you sprinkle in like 75 cents of equity a month. It's bad.
Yeah, it's horrible.
So just to imagine what the first 20 years of equity buildup would be. Now, obviously, the price is going to appreciate, but especially if you went at X appreciation, just how much you would amortize, it's basically nothing for 20 years.
Yeah.
Like you would be, if home prices went flat, you would be like, I paid how much?
It's effectively an interest only loan. And that's what Ben Hunt was saying. And I agree.
You basically pay 3X the sticker price at the end, instead of 2X, kind of how we structure it now.
Well, and then here's the catch. So we know that the average homeowner rolls their loan every 10 years on average, right? So in that setup, it is an interest only loan.
Right. No, like retirees, you know, for a good chunk of American history, retirees have their home paid off. And that's a huge deal for them financially when they're 80 years old, and to give to their kids and everything. You'll get to a point where like people will be 90 and they'll have like 9% equity, and like it just, they'll have a giant liability instead of an asset at the end of the day, which is, I mean,
because you've created artificial.
Hopefully you don't have to spell it out, but that's not good.
No, because you've created artificial demand. And these are the problems. And communist and socialist countries have shown us these examples over and over and over. You're kind of seeing a light version of it, which is, you know, it can feel really good to mute out parts of a free market at times, you know, because it strikes and gutters. But there's a cost, and things get less efficient, and things start separating from their intrinsic prices. Right. When that happens, that creates much bigger problems, right? Because now it's not just the pain caused by that asset price being high, but it's also the pain that's going to be realized when it finally normalizes. Yeah. And so you're getting drilled on both sides of it. And that's why I just sit there and go, you know, like with all things in life, and it's futile to even talk about it because we're so far down the road we can't. So I'm not going to be that guy that's just wasting my time talking about things that are futile and won't come to pass. But just keep this in your mind as a reference of why it is dangerous. And it's not always a good idea to just say, screw it. We don't want the pain. We want the easy way out. You're going to pay it one way or another. You're going to pay it.
It's eating seed corn like your Joey Chestnut. It's like a hot dog eating contest of seed corn.
Yeah.
It's just seeing how much you can get down.
Yep. And valuations work the same way, right? Like the higher you push them up, the worse forward returns you're going to get.
Like I think real estate's already has removed itself from fundamentals on,
100%.
Now, but if you compare us to a lot of places around the world, like there's places that are a lot worse, right? It's basically a religion in Australia. Their price to income ratios and all that stuff are worse. A lot of Northern Europe. Well, it's almost like we're like, well, hold my beer. Like we'll catch up. So then you have equities and housing just, detached. So then you have like this crazy like household balance sheet bubble and that's more. This is an important point. That is more destructive than the government's balance sheet having a bubble. When private balance sheets have a bubble and that bursts, that's how you get nasty financial crises and recessions. Usually when you get the government has their own bubble, like you get some inflation and that's not great, but like you don't get a nasty crisis the way you do when it's private balance sheets.
Well, and that's one of the things. Look, I don't see the stream of cash cut from the government slowing down anytime soon, but that's what does make it really concerning when you're looking back. Just look at what we're talking about: housing. We're talking about, you could put automobiles in that category to a certain degree.
Yeah, you can get 10-year
college,
now.
medical expense. Look at how many things are way higher priced than they should be. Not because of demand and natural economic forces, but because of the impacts of monetary policy, fiscal policy. Look at all those things.
We've decided that we'll take a longer time to pay for literally everything in society.
Yeah. I mean,
with interest.
You could easily see something wipe 30 to 35% off of the stock market and housing prices and still not have them be elevated or not have them be cheap.
And if that happened 30 years ago, that would be like a mosquito biting you. If it happened today, it'd be like getting trampled by rhinos.
Yeah. Well, I mean, just think about that. Like, and we've talked about this before, but just look at the market capitalization versus the entire size of the economy.
And the percentage of people's balance sheet it takes up.
What is the S&P market capitalization these days? Let's look. I would think you got to be approaching 70 trillion. I would think. Because I thought we were like 55, 60 a while ago. But anyway, what do you know where we are?
It's coming. 57 trillion.
Okay, so you're 60 trillion. So the stock market is worth twice the size of the economy.
And that's just the S&P 500, so that leaves out, another whatever 2,500 companies or something.
Yeah, so you probably call it like 65 trillion probably. Right? So you're more than double the size of the economy. So a 30% hit to the stock market would equate to a 60%, would be 60% of GDP.
Yeah, a 30% drawdown now is like a 80% drawdown was 30 years ago. As far as the impact on the consumer balance sheet, essentially.
A 30% hit to the market, you're wiping out 2/3 the amount of our GDP.
And back in the day, old people didn't own a bunch of stocks. They
CDs and bonds, and then they lived on their pension.
Now, a lot of old people don't do that, and they're out there with Mag 7 calls and stuff,
loaded up on Bitcoin and Fartcoin.
I have a research subscriber that's like mid 80s, and I don't think he's all in bonds if he's reading my stuff.
Nah, man, it's getting wild, and watching the doubling down and watching the 50-year mortgage come out and watching, it's just we're just eating seed corn.
To me, it's a bummer because I find myself rationally having to be like, well, I gotta do that. I have to participate in that. So, I'm going to go buy the house I should be buying in 10 years after I've saved a bunch of money and gotten more income and everything. But I'm like, nah, I just should go buy it now with a 50-year, because if I don't, that thing's going to double in value. It will get away from me.
Well, yeah, but that's the sad part. Here's the sad part. The other thing is this will create more space between the rich and the poor even further.
And people that understand how this stuff works, because I'm going to be front in line. I'm not missing that.
Well, yeah, but it isn't the same for you, because you have the ability through your income to be able to pay that loan off by putting down extra payments. Right. And so you can actually use it to your advantage.
But that's
so
can I feel sad that I'm going to use it to my advantage, because I know, in the end, it is going to hurt people.
But that's the perverse part of these incentives is that in
over
order
and over, you get incentivized to do the wrong thing.
Yes. In order to not because you just made a bad policy, I'm probably going to take advantage of the 50-year mortgage.
Right.
But in a weird way, I have to, because of your bad policy. I am at an economic disadvantage if I don't.
100%. So you have to just take part in this bad thing. It's a bummer, but you have to. I mean, it's basically defending yourself at the end of the day is what all you're doing.
Yeah.
So yeah, I'm going to defend myself in the marketplace.
Yeah, you gotta do it.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
Other thing though, I noticed today, again, I want to encourage people to look at it. Yeah, great day for US markets. Go look at international, right? Just go look at international.
Yeah. So let's see. We finished up about 1.5 on S&P. I know most of the day EEM was tracking. Yeah, EEM closed up 1.76. I think China stuff was about the same as the S&P. So like even on days where the US gets after it, it usually can't really still can't outcompete the average like kind of ex-US stuff.
You know, the other interesting thing too, I don't know, I'm sure you saw this, but Michael Burry put out some interesting tweets regarding the value of the long term. He was kind of looking at the financing of these chip deals and all that kind of stuff, that circular financing. He brought up some really interesting points that were right alongside of what you and I were talking about, which he said, look, depending on how you're depreciating these chips and, looking at the way that they're doing, he's like,
which Meta does over 11.5 years.
Yeah.
And in their accounting.
And he was saying that depending on how that's done, that could overinflate their earnings by 21%.
Yeah.
Yeah.
And their earnings are going to be cosmically overstated for years to come. And it's not just them, like anyone that is doing this off balance sheet stuff, whether it's lease agreements, which is, giant liabilities for the next however many years, or the special purpose vehicles to, keep some of the debt under the rug. Like they're levering up, they're soaking up demand for debt in chunks of tens of billions at a time. They're completely flattering their earnings and their balance sheet both. So the income statement and the balance sheet both get flattered by the way they're doing this stuff. And I'm not saying, some people say like, oh, those chips are like worthless after 2 years. That's not true. But depreciating them at 11-year schedule though, like that, okay.
Dude, you remember my conversation I had with the guy from Microsoft, Brad, my buddy of mine. They're doubling compute every 3 to 4 months. There's no way. There's not a single piece of equipment in those data centers that's still going to be in play 5 years from now.
Yeah, maybe the metal racks that hold stuff together.
Maybe those. Maybe those. And probably not.
Especially the way they're running them. I mean, they're using this stuff. So
they're running. They're riding it hard and putting it away wet. I mean, those things aren't even. They're getting. I mean, because they take that factory-like approach, right? Let's run these things 24 hours a day. Any downtime is wasted money. Right. And when you're renting stuff out, that's the way you think about it.
Yeah, and don't get me wrong. Do I think 5 years in you can still get economic value out of a chip? I do, but it's way less than you started. If you keep using that chip for cutting edge stuff, you're going to fall behind. So you have to, replace this stuff with the cutting edge, or you lose. As long as we're chasing super intelligence,
well, this is the other point that you pointed out that I'm really shocked that no one's talking about, which is if you look at the way the dynamics are playing out, it's not just the spend now, but it kind of goes back to that conversation we were having about the government. If you're spending like this now, and then another chip comes out, you got to keep spending
right.
Like that.
That's what bothers me the most about it. Now someday that may change, but like for now, you're just on a treadmill with the elevation setting on like 50. Like you're like rock climbing a treadmill. Like,
well,
thank you.
Right. Are you going to spend $30 billion on chips, and then 18 months later, a new chip comes out and you're not going to load up on that one? And so now everybody else that has an advantage over you. You're already 30 billion in.
Yeah.
You got to re-up for the new chip. You can't afford to fall behind.
Like I know I've made this point a million times, but like at least in a railroad, your sunk cost was useful. And here, like if you decided, let's say 2 years from now, one of the hyperscalers is like, you know what, we think super intelligence, this isn't happening. It turns out that was a science project. This isn't real. So we're going to dramatically cut back. I mean, the sunk cost at that point is just so stratospheric. And even to just do, a useful application layer data center, it still requires that ongoing. And especially if the chips get more, efficient on power, then you really need it to save yourself on the power side. Like it's just a treadmill you can't really get off of.
Yeah, no,
the Red Queen problem.
Yeah, and like I said, it reminds me of the government. Like the more you invest, the more you're obligated to keep going.
Yeah.
Right. You can't just sit there, because if you don't, what do you sit there? You got 50 billion sitting on the balance sheet and you're like, well, we gave it a shot.
Yeah.
No, you got to keep going. You know,
Yeah.
I mean, you're in for a penny, in for a pound.
Yeah.
So, what else? We got some, did we get some economic data out this morning?
Nothing today. We get small business tomorrow. We're still kind of in the blackout of where data's all dead because of the shutdown. So hopefully they do actually end the shutdown so we can start getting some data again. Although I think it's going to take the agencies maybe months to really catch up and get going again. Hopefully not. But
wow. Yeah.
so we're all stuck looking at a bunch of private sector data, and to me it's all where, roughly where we've been the last few months. It's not great. It's not that bad. Some of it's good, some of it is bad.
You're bumping along.
Yeah. Nothing says recession, nothing says boom.
Yeah, I think we got to really dig into this 50-year mortgage thing, because I think this could be, well, like you and I've talked about, if you get a housing boom, there aren't many things that are much more stimulative to an economy. And if you couple that with what's going on in AI, then that could give you some serious jet fuel to the upside here.
No doubt about it.
Yeah.
But I will say, like, I would expect, unless you're going to go in and QE the stuff away, like 10, 20, 30-year bonds to just get nuked on that. I mean, I think betting on higher yields on the long end becomes an just unbelievably easy trade if they're serious about this.
Yeah.
And it's not in a straitjacket only for, young first-time low-income people or something. Which I'm with you. I don't think they're going to put it in a straitjacket.
Yeah, I just don't think you can.
Yeah.
I think there's too many voices behind the scenes. And, here's the other tough thing. I don't think you should just do that. If you're going to roll it, you got to make it available to everybody. Like you just, that's just what I think.
I think we would have a pretty epic 2-year just squeeze in economic activity, nominal growth, and inflation. That's the other thing. Is like, if you're doing this to address the cost of living, you are doing it wrong, because this is going to create a bunch of inflation. You'll retighten the labor market up. The Fed I shouldn't say will. The Fed should at that point be raising rates significantly. They probably won't. Depends on how much political weight they have on them at that time, which remains to be seen. But
you know what this is like? It would be like, so if you think back to like 2007, this is like the inverse. If they launch that 50-year mortgage, it would be kind of like the inverse of when those temporary rates on those mortgages reset. It's like the inverse of it, right? Like how all of a sudden that started causing defaults. This 50-year mortgage hits, I think it's going to like have the inverse effect, right? But similar mechanism.
Yeah, and it'd be one thing if people bought, took out the money and like paid down debt and stuff, but but people are going to go YOLO it, right?
Yeah.
I buy some like Chipotle calls because they've been getting hit because the consumers finally like.
Well, that's what I was saying. Like,
back,
you're going to see refinancing. You're going to see people put some money in Bitcoin.
Yeah. Oh yeah. I saw a hilarious tweet. The guy's like, "I'm putting my $2,000 stimulus check as a down payment for my 50-year mortgage." He's like, "Y'all can hate all you want."
Oh man! And then the $2,000 stimulus check. I see that as simply an offering they're throwing at the populace to try to help them in the midterms.
And I actually don't think they're going to do it, because that has to go through Congress.
I don't.
But and they've teased this multiple times now, and to me, like, that's like teasing a tiger with a stake. Don't tease people with money like that. But.
Yeah. The other thing is, I'm looking at them going, I don't understand what you think that's going to help. It's not really enough to offset the impacts of inflation for anybody, but it's going to push inflation higher.
It would cost more than the tariffs brought in. So very inflationary, very, very inflationary. Oh, man. But I actually don't think they'll get that through. Now, 50-year mortgage.
I don't know who can vote against it.
I don't think Congress has to. Yeah, you're right. I mean, if you go beat people over the head hard enough and, shame them on social media enough, maybe they will vote for it.
Well, also, like, just how many people want to sit in front of Piers Morgan and explain to them why they don't want mortgage prices to go lower for people? You know what I mean? Because that's the way it's going to get framed. Why are you against people having lower mortgage prices?
Yeah.
I'm not. I'm against them being 20 years more in debt prison. But, whatever. Yeah, I just the $2,000, that one is much more up in the air to me. If they need to vote on the 50-year, I just don't see anybody standing against it. Maybe somebody on the right will, like a Massey or a Kennedy or something like that. But
no, I think that gets through. I don't even know if it has to be voted on, honestly. I think, but obviously the stimmy checks that has to come from Congress, and I struggle to see them getting that through personally. But unless they got browbeat hard enough, but for now, I just don't see that one happening. But if it does, and if you get both, I mean, man, you just all those crazy zero hedge second wave inflation charts of like, oh, in the 70s it took a giant second wave, and that I was rolling my eyes at a year ago. Well, they'd all just become true.
Yeah, and all policy driven.
100%.
Yeah,
like at least the COVID inflation was policy driven too, but like you had a background of excuse there of like, well, we turned the economy off, so we probably should throw some money at it. This time it would just be like totally like, voluntary. Like you chose it. Like it was just a choice.
Yeah.
Not like let's put this fire out with some money. It's just like let's make a fire with money.
Wow. Well, the one thing I can promise you, and it's been like this for a while, is that it's not going to be boring.
No,
right? There's a lot more acts in this play, and the irony though is that every single time I see one of these things, and even I see the market reactions in the market, like I still think it's fairly easy to play.
Yeah, the market doesn't really care. Like now, obviously, if this stuff passed through, I'm assuming it would care, and if it didn't care, wow, would that be an opportunity? But
no, I'm just saying.
But although if you go back to COVID, the market didn't care. Like,
no, but what I'm saying is that all of this stuff feels like you're memorializing and you're locking in an extended down market for the dollar, right?
Yeah,
right, and that's what I'm saying. So then, when you look at the valuations, the case that we've been making about international versus U.S., every policy decision I see, I feel like they're just cementing that decision further and further and further. And like we were talking about last week. There have been a lot of times over the last 10 years where people have called for that bottom in international and emerging markets versus the S&P 500. What was different then? You were still in a dollar bull cycle.
Yeah.
You're not now. And every single one of these policy decisions that comes down seems to just further encase that and secure that and lock that in.
And to add to that, if you did get a yield spike, which you should, based on that, obviously, so the 30-year should be like 7% almost instantly, in my opinion. But if you got that and they were like, well, we're not going to let that happen, and you came in and you put a lid on it with QE and like, hey, we're not letting it go above 5. That's when the dollar, I would assume, just gets completely destroyed. I don't want anyone to like go crazy with me saying dollar get completely destroyed because of all the doom mongering that gets used on that exact narrative. But DXY would not be in the 90s anymore if you pushed inflation and then kept the bond market, immune response from activating. That is how you really get the dollar down, is because at that point you are going full blown emerging market like policy along the way. And that, look at the history of some of the worst emerging market policy and what that did to their currency.
Yeah, it's good times.
That would make a bonanza for actual emerging market stuff at that point, because then all of a sudden they look good compared to us on a balance sheet statement, income statement.
Yeah, the other side is too, with all the stuff that we're talking about. If you think real assets are attractive right now, sweet Moses.
Yeah,
I mean, just you take any type of top or limit off them.
Everything comes back to overseas equity and real assets. And
here's the deal: if you think about it, I don't really feel like we're sitting here discussing kind of like this tail risk of this happening. I mean, if you walk through it, like I think the likelihood that we don't continue down this path and continue doubling down on these exact same policies, I think the likelihood of that is almost zero.
Yeah.
Do you know what I'm saying? Like,
no matter who's in charge.
Yes, because and we've been saying it for years and years and years. And why would it not be true now? And as a matter of fact, when you look at them, right, there were so many times over the last 15 years where we actually had flexibility as far as what policy we could pursue. We don't know, at least in the policymakers' eyes, right? Because if the choice is to make this decision for the long-term health of the economy, but it's going to cost me my next election.
That's somebody else's problem.
Yeah. And that isn't a decision, right? That's, immediately that we scratch that one off the list of possibilities, right? So I'd sit there and look at this right now and go, that has to be everybody's base case.
Yeah,
Right?
I think that's where the game theory is. It's like if you're betting on political self-preservation, it's kind of obvious where this goes.
Yep.
And if you're not betting on political self-preservation, like, please let me know why.
Yeah, you're not paying attention. So anyway, you got anything else, my man?
I think I'm good.
All right, brother. Well, as you guys know, you can follow us on social media. I'm on Twitter at KYR Radio. Chase is at Pinecone Macro. Get our video feed on YouTube. Just search Know Your Risk Podcast. Go to knowyourriskpodcast.com. Download and subscribe. You guys know the drill. Have a great evening. We'll see you again tomorrow. You're listening to the Know Your Risk Podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.